Welcome back, everyone. Glad you're here because today I want to have a real conversation with you. Not a hype video, not doom and gloom, just a calm, honest look at what the data is actually telling us right now. Bitcoin is sitting at 70K as I'm recording this. Fear and greed is at 11. That's extreme fear. We've been here before, but today I want to walk you through why this moment is actually different from the ones we've seen recently and why there is one specific level below us that you need to understand before anything else. By the end of this video, you're going to know exactly what the chart is warning us about, what the on-chain and institutional data is confirming, and what that means for your positioning right now. The number that matters most today, $68,000, the 200-week EMA, the last major support level between here and a very different conversation. And the evidence building around it right now is something I think you need to see. And there's one data point from the mining side of this market that almost nobody is connecting to the price right now. I will show you exactly what it means in a few minutes. Bitcoin has now made 3 attempts to break back above 75k in the past 2 weeks. Every single time it's been rejected. That's not a random pattern, that's a market telling you supply is heavy above that level. And buyers are not showing up with enough conviction to clear it. The 200-day EMA is all the way up at 86k. That's 21% above where we are right now. That gap doesn't close quickly in an environment like this one. Below us, the 200-week EMA sits at 68k. And here's the honest truth about that level. It has held every major crisis in Bitcoin's history. COVID, FTX, the yen carry trade, every time. And this is important, it has never been tested against an active multi-week geopolitical war that is actively keeping oil prices elevated and institutional capital in risk-off mode. That's a new variable. Now, let me give you to the historical parallel that is actually on the table right now. In February 2022, Russia invaded Ukraine. Bitcoin initially sold off, then posted a 24% relief bounce over the following 4 weeks. A lot of people called the bottom, and then Bitcoin went on to drop another 64% by November of that same year. The current war in the Middle East started on February 28th. Bitcoin rallied almost 10% in the first week. The momentum is now fading, and we're sitting in the same kind of exhaustion point that preceded the deeper 2022 move. I'm not saying that's what happens, but I'm saying that pattern is close enough that it would be irresponsible not to talk about it. But here's what makes today genuinely different from any of recent pullbacks, and it's coming from inside the Bitcoin network itself. Stay with me. If you're thinking about adjusting your positioning around these levels, Bitunix is what I personally use. Clean platform, quick execution, link is in the description. Now let's talk about what's happening on chain because this is where today's video earns its title. Bitcoin's mining difficulty just dropped 7.76%, the second largest downward adjustment of 2026. Mining difficulty, for anyone newer to this, is basically a measure of how hard it is to produce new Bitcoin blocks. When it drops sharply, it means a meaningful number of miners have gone offline. They've turned off their machines because they can't afford to keep them running. Post-halving, with oil prices elevated and energy costs rising, the squeeze on miners is real. And it's showing up in corporate numbers too. Bitcoin miner BitFuFu just reported that its self-mined Bitcoin output collapsed 76% last year from 2,537 Bitcoin down to just 611. Their revenue from direct mining fell 60%. They've been forced to shift away from mining Bitcoin themselves and towards selling cloud mining services just to keep the business viable. This is what miner capitulation looks like in the data, and historically miner capitulation is one of the signals that can actually precede further price weakness before a recovery because miners who are underwater have one option: sell their Bitcoin to cover costs. Now here's the dormant wallet story, and I want to frame it this carefully because it matters. A Bitcoin wallet has been completely untouched since July 2012. 13 years and 7 months just made its first move. The wallet holds 2,100 Bitcoin, now worth 147 million. The initial transaction was tiny, just $56 worth, but in the on-chain world, that tiny move is almost always a test transaction. You send a small amount first to confirm the wallet works, then the bigger move comes. That's not panic selling, that's a patient, rational person who held through everything and may now be preparing to take some profit at 70k, and they are not alone. Over the past month, we've seen multiple Satoshi era wallets wake up. Each one is a potential supply overhang sitting above this market. And on ETF flows, spot Bitcoin ETFs saw 250,000 $1.3 million in outflows over just 2 days. Monthly flows are still positive at $1.48 billion, but that number sits against a backdrop of $6.3 billion in cumulative outflows between November and February. The recovery in institutional demand is fragile, not firm. Now the macro picture, because what's happening in oil and equities right now is the part that connects all of this together, and honestly it's the most important piece. Let's zoom all the way out. The war between the US, Israel and Iran entered its 4th week. Crude oil is up 53% since the conflict began on February 28th. Brent crude briefly touched $119 before pulling back. That is not a temporary spike, that's a sustained structural energy shock. And what this has done to institutional capital flows is striking. The SPF 500 ETF and the Nasdaq 100 ETF saw a combined $64 billion in outflows over the past 3 months, the largest on record. That reverses a $50 billion inflow that came in after the November elections. In other words, everything that came in on optimism has now gone out on fear. Bitcoin is not immune to this. When $64 billion leaves the 2 most liquid equity ETFs in the world, that risk-off move ripples everywhere. And this is what Glassnode confirmed this week. Geopolitical uncertainty is compressing the market's ability to absorb even moderate selling. Buyers are pulling back, demand depth is shrinking. The honest summary of the macro right now: high oil, tight Fed, risk of equities, and a war with no clear end date. That is not a backdrop that historically allows Bitcoin to sustain a significant recovery. So let me tell you exactly what I'm doing with all of this and what the one level is that changes everything. When I'm managing my positioning around major levels like this, I do it through Bitunix. Simple, clean, does what I need. Link is below if you want to check it out, by the way. Now, let me be straight with you. I'm not here to tell you Bitcoin is going to zero. I'm not here to tell you to sell everything. That's not the point of the video. The point is that the evidence right now, the chart structure, the minor capitulation, the dormant wallets waking up, the institutional capital exodus, the geopolitical backdrop is pointing toward a period of continued weakness, not recovery. Here's how I'm personally thinking about this. I've reduced my exposure, not panic sold, reduced. I have a meaningful amount in cash waiting on the sidelines, and I have a very specific plan. If 68k holds on a weekly close, I start looking for early re-entry signals. The 200 week has earned that respect based on history. If 68k breaks on a weekly close, I'm not catching that falling knife. The next real conversation starts around 55k to 60k. That's where historical support structures exist below the 200 week. And here's the thing about having a plan like this, it removes emotion from the equation. I'm not watching every candle, I'm watching one level, 68k on the weekly chart, that's it. Now, I want to be clear about this. Bitcoin has survived every single bad macro environment it has ever faced. The fundamentals haven't changed, the supply hasn't changed. There are still only 21 million Bitcoin that will ever exist, roughly 4 million of which are gone forever. The dormant wallet that woke up this week held through a 10,000x gain because the long game on Bitcoin has always worked. That hasn't changed. But right now the data is telling us to be careful, not fearful, careful. That's a difference. So here's the full picture. Base case, 68k holds, the war begins to de-escalate, oil pulls back, institutional outflows slow, Bitcoin grinds sideways and builds a base for the next move. Risk case, 68k breaks on a weekly close, the Russia-Ukraine 2022 pattern plays out. Relief rally already happened. Now the deeper move begins. 55 to 60k becomes the next conversation. Now the level to watch, 68k weekly close. Nothing else matters until we know the answer to that question. You've now got both pictures, the chart picture and the positioning picture. I've said what I think the data is saying. Now it's your job to make the decision that it's right for your situation, your risk tolerance, your timeline. We will watch 68k week by week. Let me know what you're thinking in the comments, and I will talk to you guys in the next one.